Hello, I'm Graeme Bibby, Chief Investment Officer, joined today by Matt Leong, Portfolio Manager. We're here to give you the outlook for the rest of the year in July 2026. So to start off with growth around the world, what have we been seeing? So for the globe, we've had an aggregate of expansion across these measures of expansion of economic growth, which is the Purchasing Manager Indices for manufacturing and services. The US has also been expansionary through this period, although it's slowed a little bit. But interestingly, Australia has slowed down. So it's slowed down below this line, which means a contracting economy or a slowing economy. And that's due to two factors. One is the RBA hiking rates quite early in response to quite an expansionary economy here. So it was actually quite strong. And so they pulled on the brakes quite early. And then after that, the tax changes that came through with the federal budget in May. So that actually changed sentiment quite a bit as well and slowed things down. Everywhere we've seen the impact of oil prices, and that's had an impact on inflation, which we'll turn to next. For inflation, compared to the COVID period, which was quite a big up and down pulse, we've started to see this little pulse here of inflation due to the oil crisis. We've also seen that flow through in the US. Australia, we look at the quarterly statistics, and that hasn't actually moved very much at all. But in recent data, the headline figure has moved up a little bit, and some of the core measures are starting to move as well. So inflation is starting to move, but we don't see it anywhere near as the level of the COVID era. So on other factors, Matt, so technicals and valuations, what are we seeing?
Yeah, so valuations are pretty stable over the last quarter. Even though the markets have moved quite a bit higher, that has been supported by strong earnings growth. As Graeme pointed out earlier, economic growth has been pretty solid globally, which has supported earnings growth, and therefore valuations have managed to stay around the same level of PE multiples, for example, relative to where they were a quarter ago. On the technical side, where we generally look at positioning and sentiment, that has had a strong impulse early in the quarter as we recovered from the, reopening or thought of reopening of the Strait of Hormuz. However, we've had a little bit of a sell-off in the last week or so as we are recording this, and that has also actually brought sentiment and positioning back down pretty sharply towards a neutral level, despite not seeing that big a sell-off. So adding that together, we see that as a fairly positive backdrop. And as a result, we continue to be slightly overweight on equities and overweight on our risk allocation, with a preference to global equities over domestic equities, being that global equity earnings have been quite strong, the global economy is holding up pretty well, and domestic earnings have been a little bit weaker and are expected to be a little bit weaker given a weaker backdrop for the local economy. And in fixed income and private markets, Graeme, what are you seeing on that side?
Well, we'll start off with the cash rate because that's the short end of fixed income markets. In Australia, we've seen quite a move up and down in the rate expectations. So the black line is the actual RBA cash rate. You can see the RBA has hiked. And interestingly, a 1 year forward 3-month rate has anticipated that. So it's actually come up 4. It's anticipated the moves down, anticipated the moves up, and only recently has ticked down. So that's indicating that the expectations are starting to normalize. So perhaps we won't get another hike. In the US, we've had a similar situation where rate cuts have been priced in by the markets for quite some time, and that's come down. But since Kevin Warsh, as new Fed governor, has come in and markets have interpreted what's been going on, we've actually seen an expectation of hikes starting to come in. So that all flows right through the yield curve to long end rates as well, where at the long end, we also see government bond rates having moved up with the oil crisis, but then having come down again, not to the same level as that they were before, but they've normalized somewhat from that level. Credit spreads have been somewhat benign, so they've actually come up and come down again to pre-crisis levels, pre the war. So all in all, we don't see a crisis in fixed income or in credit. And in private markets, particularly in private credit, some of the concerns there we think are overblown. Some are understandable with some redemptions that are happening out of some of the US private credit funds, but in aggregate, the sector's pretty healthy credit-wise. Other private markets, private equity is reasonably healthy as well, with more M&A activity and IPOs, such as SpaceX, and infrastructure is pretty well supported, given it has an inflation connection, and there's a lot of infrastructure build out for the AI downstream needs for energy and data centers, and also roads and other things that are for logistics for the onshoring, nearshoring. So we see private markets as having a lot of opportunity.
Yep. So overall, we are cautiously optimistic. We do have a constructive view on risk assets and growth assets. And as a result, we're happy to maintain our current slight overweight to growth. We are watching risk closely, and the biggest risk that we've identified as a team at the moment is on the inflation side, where expectations for a longer and higher period of inflation would be an issue for markets. So we are watching indicators of that pretty closely. Apart from that, we are cautiously optimistic, and hopefully returns will be good to the end of the year.
Thanks, Matt. So any questions about the presentation, your portfolio, and what's going on, please see your investment advisor. Thank you very much.
Thank you.